Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for 3 Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. This is video number 2 in our end of 2021 market roundup and outlook into 2022. And now it's time to bring out the big guns, or perhaps the smaller ones, US equities, but not as you know them. To give us his view of 2021 and outlook into the coming year, I'm absolutely delighted in bringing to the channel a legend in US smaller companies investing, Richard De Lisle, who runs the De Lisle American fund. And this fund looks completely different to pretty much all other US equity funds out there due to 2 reasons: small cap and value. And as a result, the performance has been very, very different too. And I think after that introduction, I may well have piqued your interest. But first, before we get into the content, as ever, it would be wonderful if you haven't already subscribed to please do. It really does support us in bringing to you weekly content from both investment planning and financial planning also. So, onto the content. Richard, it's great to speak to you once again. Many thanks for your time and your valuable time in coming into the channel. Setting the scene for today's video, global markets have been dominated by US large cap tech names for recent years, for time immemorial it seems at this moment in time, and therefore dominating clients' investment portfolios. Why do you believe now is the time for US smaller companies to shine?
Andrew, thank you for having me. Small companies, and I've never had an introduction like that, so thank you so much. Small companies, it is their time. Well, it's their turn. Simple as that. It's their turn. As you say, it's been against them for so long, but let's not forget they are the long-term outperforming asset class with value stocks over 100 years. They still are, even after missing the last 10 years or so, and it's their turn now because the valuations are so skewed towards large cap. The elastic band is stretched as far as it's been.
Mm-hmm. It sounds somewhat inevitable. Is there some kind of catalyst that you think will actually trigger this?
Yes, I mean we're living the catalyst. We're living through the catalyst now. The catalyst was triggered by COVID, and it made a change in the interest rate cycle. Mm-hmm. And it's I'm so sorry.
Oh no, yeah, no problem at all.
I'm so sorry. It's triggered by COVID, and that meant a change in the interest rate cycle. We've had a change in the long-term interest rate cycle. Small companies do better when there's inflation. The best period ever for small companies was 1975 to 1983, mm-hmm. and that was an inflationary period. And the big stocks did well because interest rates were going down for 40 years.
Yeah,
and that whole period is over now.
Yeah, and obviously looking at the other side of the coin, the value approach that you do have, that's been embedded for years and certainly embedded within the fund. Why should investors again finally give up, or not so much give up, but start considering value as opposed to growth, which has dominated for the past 10 years?
The diversification, really, because you're going to get more and more uncomfortable with growth at higher and higher levels, mm-hmm. and so you need to think about diversifying as they get more and more dangerous. I mean, already in the last year, we've seen how growth is falling away,
Mm-hmm.
how the more marginal growth at the sidelines away from the main cash generators is not doing so well.
Mm-hmm.
And so it's a narrower and narrower leadership, which is a classic sign of a top coming.
Yeah.
So the last ones left on the beach are doing all right,
Mm-hmm.
but you don't want to be the last one left on the beach.
No.
It's a dangerous place to be. You want to get into this group, which is so cheap.
Mm-hmm.
It's a cheap group as the world is changing. If you think inflation's coming, these stocks will do better.
Yeah. And again, you're right. Inflation is on everyone's lips in this rotational period that we're looking into, whether it's transitory or not. And whether you believe that central banks are being are opening themselves up to policy error because of this. Moving into 22, it does seem to be the dominant factor that is playing into clients' portfolios. Looking at your fund specifically, are there any areas that you are excited about where you could add differentiation to clients' existing US allocations?
Well, I mean, overall, our fund is much cheaper. People think the American market's so expensive, and it is. It's on 29 times trailing earnings. Mm-hmm. Our fund is on 9.3 times trailing earnings. It's less than a third of the market. So those ratings are comparable with any value or small cap funds anywhere in the world. So the American market is not expensive away from the big cap leaders. Where we can add value is that America is the place where the small caps live. There's thousands of them, and the move we've seen this year is basically across the board in these sectors. So I'm not going to say, well, we've got this sector and no one else has. I mean, we've got a sector called community banks, which doesn't exist anywhere else, which is the main value sector. Mm-hmm. And we've got a lot of them. It's the main value sector in the American market. Mm-hmm. We've got stocks that give you experience as the world comes out to play, when experience is what is wanted. Mm-hmm. So we've got various themes within the portfolio which are doing very well. Within the commodities complex, we're in certain commodities that you can only really play well in the American market. And all these things are value-driven things, which with inflation coming back, first of all, if you're in a low PE fund, you're less vulnerable to the change in the market that inflation will cause through taking PE ratios down. Mm-hmm. You're less affected by that, but also you're in a place where markups can be passed on. So that's where we are. We actually welcome inflation. It plays well for us.
Yeah. Well, it seems like obviously history's on your side, and certainly when I look at positionings within portfolios and taking into consideration so many different sectors globally, valuation entry point is pretty much crucial. It's kind of investment 101, buy low, sell high, which because of central bank intervention over the past 10 years and we've gone from that to buy high, sell higher, which maybe it's time for a bit of change. Bottom line is people need diversification, and I can certainly say that from the research that I've done, your fund adds that to standard US allocations. So it'll be interesting. It'll be interesting to see how 2022 evolves, and if it's anything like your recent performance, then it should be a bit of a cracker. Anyway, Richard, as ever, it's great to catch up with you. Great to talk to you. You stay safe, and I'm sure we'll catch up soon.
Thank you very much, Andrew. Thank you. Look forward to seeing you again.